Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Brooke DiPalma. She is here to keep the discussion simple and pointed toward you, the listener. Today, we're going to be focusing on the bond market and the economy. If you care about your mortgage rate, your car payment, or whether stocks keep climbing, you care about bonds. And our phrase of the day folds in, it is yield curve. We tackle it bit by bit, what it means for investors and what it helps predict for markets and the economy. And this episode is brought to you by the number 1951. That was the year of the so-called Fed Treasury Accord, when the Federal Reserve stopped guaranteeing lower, longer-term interest rates as a dedicated buyer of Uncle Sam's bonds. It established Fed independence, which is now a major policy issue. And today we are welcoming Collin Martin. He is a director and fixed income strategist at the Schwab Center for Financial Research. Collin specializes in translating bond market moves into plain English for everyday investor, and that is perfect for telling us what today's Fed decisions and the yield curve mean for your wallet, not just Wall Street. So we're going to dig into the yield curve explanation in a minute, but just give us your overview. Why should investors care about bonds right now?
Well, we think investors should always care about bonds. We really see three key benefits to bond investing, regardless of the interest rate environment. The income they provide, because that's a key feature of bond investing. For those who aren't too familiar,
Sure.
They make regular interest payments, where if you look at stocks, a lot of them pay dividends, but they're more discretionary. So less safe, you could argue. You also get capital preservation, especially if you're focusing on high quality bonds. The idea that you're going to get your money back, I think that's really important. It can be great for planning purposes. And then the third key benefit is diversification. You want to have investments that aren't all moving in the same direction at the same time. Might sound great if everything's going up, but when things are going down, especially if we see a stock market decline, you want something that's going to help serve as a buffer in your portfolio, and high quality bond investments can help do that.
Great. And we're going to circle back to a lot of those points. And let's get into our phrase of the day right now, which is yield curve. It is a timeline of interest rates moving from the near term to decades out, showing the going rate of what money costs at each future point. Its shape basically signals inflation expectations, growth expectations. And I should also say that we're talking usually about the Treasury yield curve, so that's government bonds, but you can also have a corporate yield curve for a company like Apple or McDonald's, whatever. So we're going to focus on the Treasury yield curve here and just kind of break it down why this matters for investors and then kind of how to interpret it.
Well, let's look at it from two ways. What matters for investors? So we hear about the yield curve. We talk about the yield curve. I think a lot of investors might not really get what it is. So it's a line that connects the dots of treasuries of all maturities. So we start with short-term maturities, as you referenced, and all the way out to long-term maturities. So maybe you start with a 1-month treasury bill all the way out to a 30-year treasury bond, and that just connects the dots of the yields they offer. And sometimes long-term rates are higher than short-term rates. Sometimes long-term rates are lower than short-term rates. And that can be confusing for a lot of investors, because when you're looking at that yield curve, it's basically a menu of options, right?
And it's not always a curve. Sometimes it could be flat.
So it can be flat. There can be kinks in the yield curve, and we're kind of seeing that right now. So that's what it is for investors, how you want to approach it, but it can tell us things. And a lot of times when it's inverted, which it's kind of inverted now, parts of it are inverted now, but when the yield curve is inverted, again, when that's long-term rates lower than short-term rates.
Which is not intuitive, because longer-term money is then cheaper than the short-term money.
Right. It doesn't make much sense. It doesn't make much sense for us as investors, right? Why would I accept a lower yield on, say, a 10-year treasury note, locking my money up for 10 years, when I can get a higher rate with, say, a 3-month T-bill that has much less volatility? It doesn't make much sense, but it's usually based on expectations. And when there's expectations for the Federal Reserve to cut rates, usually due to declining inflation or maybe a weakening labor market, that sends longer-term yields down in anticipation of those potential rate cuts.
And I guess, what should investors be eyeing right now with that September meeting in mind? How should they be thinking about this?
The main thing we're looking at with the potential for a September rate cut, it's what we expect at Charles Schwab, is the idea that the short-term investments that you may be holding, you might start facing reinvestment risk. this is
break
something
that
that's
down a little bit,
this
please.
is something that's really interesting. But reinvestment risk is the risk that when a bond or investment you have comes due, that you might have to reinvest those proceeds
You
at
want
a
to get
lower
back.
rate.
You want to get back in, and ultimately that could cause
You might
maybe you won't get it at 4% anymore. Maybe you'll get it at, say,
3.75 if the Fed cuts 25 basis points.
Right.
So.
Yeah, that's the best way. Thank you. That's the best way of describing it. Right now, let's say you can get a T-bill, 3-month T-bill, we'll say at 4.25%, close to the Fed funds rate. In a few months, when that comes due, maybe it's 4% or maybe it's less. So reinvestment risk in a declining short-term interest rate environment means that if you're holding short-term investments, you might see your income decline over time.
And that could be a savings account too, money market funds. And so when we talk about the yield curve, it depends on where you are in the yield curve, but on the very short end, a lot of times we're talking about savings account rates or money market funds. Then you go out to 6 months a year. Maybe you're talking about CDs, and then you go out to 5, 10 years. You're talking about auto loans, mortgages, that kind of thing. So I guess break down maybe for us some of the misconceptions that people might have about the yield curve or just bonds in general. Like what do people have? How can you help people understand them a little bit better? Because there is a lot of misinformation, but really misunderstandings about them.
yeah.
I do think there's a lot of misunderstanding out there. And I'd say the biggest one is that a move by the Federal Reserve, whether up or down, is going to directly influence mortgage rates. And that's not the case. And we saw that last year. So in September, the Federal Reserve cut interest rates by 50 basis points. And actually, over the next 2 meetings, cut by another 25 basis points.
And then what happened? The opposite.
Mortgage rates went higher.
Yeah.
So I think that's really, really important because mortgage rates are not based on the federal funds rate in the here and now. It's based on expectations of the next 10 to 30 years, because that's usually how long a mortgage is. And even though the markets tend to act in advance of those rate cuts. So we saw that mortgage rates had fallen a little bit last fall.
Right.
And then when the rate cuts came, there was this idea that maybe we didn't need to cut rates as much. And if more rate cuts than expected actually resulted in kind of more consumer spending, maybe there was some pent-up demand that got kind of released there, maybe that would result in inflation reaccelerating a little bit. It didn't really happen yet, but I think that's what caused mortgage rates to actually rise despite those cuts to the Fed funds rate.
Lots of non-intuitive stuff. Wanted to ask you about corporate bonds and how to invest in those, because it's not just buying Uncle Sam's debt. You can buy the debt of even NVIDIA or Apple or whatever. And we talk about high yield versus investment grade. Just kind of walk us through those terms.
Well, the whole bond market is really large and complex. I think that's probably what scares a lot of potential bond market investors away, because it's not as simple as the stock market. There's a lot of different types of bonds out there, whether it's U.S. Treasuries, like we've talked about, certificates of deposit. That's a bond investment, a fixed income investment. Then there's corporate bonds. So they're issued by corporations, but the credit quality of the issuer, the fundamentals of the issuer can vary. So it's really broken up into two markets. There's the investment grade corporate bond market, and that has credit ratings of BBB or above.
So safe.
Those are safe-ish.
In quotes. Yeah,
so
safe-ish.
the way we look at it is it's low to moderate risk, because investment grade can be as high as AAA and then down to BBB. So the highest two rungs, that's pretty low risk. And then when you get to single A and BBB, which are still investment grade rated, it's more moderate risk. Below that, so BB or below, is what we call high yield or junk bonds. Junk bonds, obviously, is a popular term out there. Those are riskier companies. They have a lot more debt relative to their earnings. They have more volatile cash flows, and usually you earn higher yields by lending to them or investing in them. And that's true today, but the relative yields are relatively low. So you're not getting compensated too well for the risks. And in an environment where we're worried about potential economic growth moderating, corporate profit growth moderating, if you're not being compensated well for those risks, we don't think it makes too much sense. So we're a little bit more cautious on high yield bonds. We don't say you have to avoid them, but just consider them in moderation. But investment grade corporates, low to moderate credit risk, we think can make a lot of sense. You can get average yields around 4.5% or 5%. That's still well above levels we could have seen, say, from 2010 to 2022 for the most part. So we think yields are still really attractive, and you can earn those without taking too much risk.
For an investor who is interested in learning the ratings right now of these potential corporate bonds, where do they understand, where do they go to learn where the most risk is versus risk off?
Well, if you're interested in individual bonds, which I will say is tricky. If you're buying individual bonds, whether it's corporate bonds, municipalities, you need to do a lot lot of work yourself.
Yeah.
Kind of harder than stock picking, maybe.
Yeah.
I think so. I mean, you mentioned Apple before. If you want to buy Apple stock, I think it's AAPL. I'm a bond guy, not a stock guy, but I think that's what the ticker is.
You're on point.
If you're looking for an Apple bond, there's a lot. I don't know how many there are, but there's different maturities, different coupon rates. The credit ratings, I think, should be the same, depending on subordination, but there's a lot of different options out there. And then consider the fact that then there's just a lot of issuers out there. So which issuer do I want? What credit rating is the sweet spot? It's pretty difficult. So what we would suggest, if you're an investor looking to buy individual bonds and whatever, your brokerage account, if you're looking and screening, we always caution against screening for the highest yielding ones. That usually means there might
risk.
be more risk than the credit rating suggests. So you have to do your homework.
Yeah, and then also, too, I do want to take a step back because bond markets got so much attention earlier this year as investors, or rather, there was this overall fear that the government wouldn't be able to pay back bonds. Is that fear valid after thinking back? Is hindsight 2020?
So we don't think that fear is valid. We hear about concerns about our fiscal trajectory.
Right.
We hear concerns about a failed Treasury auction. That's how the Treasury issues debt. There's an auction. A failed Treasury auction for us, it's not the idea that they literally can't issue debt, that there's no buyers. A failed auction is just demand isn't as strong as we would like.
Because people were ultimately selling them because of the potential implications of tariffs.
Potentially. I don't know if it's so much selling or just are the buyers that we're hoping will step up to buy, are they still around?
Yeah.
And we, over time, we've never found too much of a relationship between our debt levels, deficit levels, and what that means for the level of Treasury yields. And sometimes that ruffles some people's feathers because there's this idea that if our debt continues to grow, there has to be an impact on yields. Our yields need to surge.
I mean, we see it around the debt ceiling sometimes because that's a very immediate problem. But to your point, over the long term, I do think I hear you there. It's not necessarily a big a factor as we might think when you hear these 10, 20, 30 trillion dollar deficits and debt and all that kind of stuff. We do need to pause right here. We are going to take a short break. But coming up, we're going to be talking Federal Reserve independence, how we got in it in the first place, and why it's a big deal these days, and calling all home buyers. We've got a runway showdown featuring two different styles of mortgage rates. Stay tuned. This episode is brought to you by the number 1951. That was the year of the so-called Fed Treasury Accord. The Federal Reserve had been a guaranteed buyer of U.S. debt for over a decade, since World War II, and this guaranteed low interest rates for the U.S. government. So mortgage rates were also kept low. But a big downside was that the Fed didn't have much control over price inflation. So this accord or agreement, it meant that the Fed would no longer fix long-term rates, interest rates, and instead they would just worry about short-term rates. And it established Fed independence, the idea that decision-making in America's central bank would not be subject to the policies and spending of the U.S. government. So break it down for us. This is an issue that's kind of come to the forefront now because people say, well, this is the way things have been for decades, and they've kind of been good this way. But then you have a president who's calling for more explicit control over the Federal Reserve's action. How does it all come together?
So the way we frame it right now is, and we talk about Fed independence and why we think it matters. And I think you made a really good point that when we talk about Fed independence, it wasn't always the case. We saw coordination between fiscal policy and monetary policy, especially after the World Wars, but then that shifted in 1951. The way we view it is if monetary policy starts working with fiscal policy for the short-term benefit of a given administration, that can have negative long-term effects. And who knows what's going to happen over the next few months, few quarters. But we're in an environment right now where inflation is still high. Maybe it'll come down a little bit over time.
Higher than the Fed's target of 2%.
It's above the Fed's target of 2%, and over the past month or two, moving in the wrong direction. Now, on the flip side...
Away from that target.
Yes, moving higher, not lower. Then you have a labor market that is weakening a little bit. But with inflation so high, if the Fed were to cut rates, either modestly or aggressively, and that stimulated demand, and as a result of that, if consumers started borrowing more to spend or businesses started borrowing more to invest and hire new people, that might spur more inflation. And that goes against one of the Fed's mandates. Their dual mandates are price stability and maximum employment. So if you do things that might help in the short run, hey, the economy would probably grow more than it would have otherwise, but the negative effect could be higher inflation, could be higher long-term interest rates because of that inflation, and it could be a decline in the dollar if there's a loss of confidence in our economy.
Go ahead.
I was going to say, looking out, all the discussion has been around Jerome Powell's finishing come May, I believe it is. And then on top of that, I mean, President Trump has been in office for now more than 200 days, and we still have the next 4 years. But when you think about long-term implications, how long are we talking about? How long could that impact interest rates beyond President Trump's time in office?
Well, I think it could, for long-term, that's a great point. It can vary. We think what it could do is create a lack of confidence. If you're investing in an economy, whether it's in our economy by investing in businesses or holding our treasuries, you want consistency and you want trust in the data and that they're going to follow what their congressionally mandated mandate is. And if they stray from that, that can just result in again, that weaker dollar and higher long-term yields. I don't have a time frame for that, but just the idea that investors might demand more of a risk premium to hold something if they're less uncertain about what the policies might look like in the coming years.
I want to introduce some other terms here, and I hope this doesn't get too far off track, but whoever the next Fed chair is, and we'll know that before next year, hopefully, they're going to be dealing with very high debt levels, and there's going to be a lot of pressure for them to maybe enact some policies that we haven't seen in a while. One would be quantitative easing, and that's kind of letting the balance sheet grow. The Fed would buy bonds, and right now they're running those bonds off of their balance sheet. So they're doing the opposite right now, quantitative tightening. But then there's another thing called yield curve control, and that's where the Fed acts not only on short-term rates, but also on longer-term rates. And that sounds a lot like pre-1951. That's when, the Fed is also trying to keep down those longer-term rates. And so then does that call into question Fed independence?
I'd say it depends on what the reason is. So you mentioned quantitative easing. Mm-hmm. That's when the Federal Reserve buys long-term securities to pull down those rates. And they did that following the financial crisis. They did that in 2020 during the COVID-19 pandemic. Sure. I would say those would be characterized as emergencies or near emergencies. To use that in a still growing economy, and to do it just to lower the potential interest expense of the government, I think that's a risk. And what we think could happen, well, it'd be tough to know what happened because if they actually do embark on a QE and the Fed is buying long-term rates, that pushes prices up and yields down. But we worry about where are the rest of the buyers? Mm-hmm. And I alluded to this before. If there is a lack of confidence, do foreign buyers maybe step away a little bit if they're less certain about what they can expect over the coming years? And if those buyers aren't there as much as they've used to be, that could result in long-term yields drifting a little bit higher, which would do the opposite of what the administration might be looking for.
And so ultimately, it's important at the end of the day that this dual mandate of them just focusing solely on that stays in place.
Yes,
I hope so. Also, I think it could just be a moot point because Fed Chair Powell's term is up in May of next year.
Yeah.
Expectations that we get from the Fed funds futures market is that the Fed might cut 3 or 4 times by then. Right. Now, that wouldn't be to the 1 or 2% level that President Trump suggests the rate should be at, but that'd be a full percentage point of easing by the time that happens. So maybe the pressure isn't there as much because yields would have already fallen. Also, it's a committee. Yeah. And even if we do get a new chair that is trying to push that agenda of sharply lower interest rates and a Fed funds rate that needs to be at 2% or below, I'm not sure that new chair would get the support of the rest of the committee members.
Right.
All right, we got to pivot a little bit, but we're going to stick with the bond market discussion here because on today's Who Wore It Better, we have 2 household choices for a mortgage rate hitting the runway right now. So on the left catwalk, we have the fixed rate mortgage. Lock it in, same payment every month, zero surprises. That is peace of mind that you can't budget. On stage right, we have the adjustable rate mortgage, or ARM. Usually starts lower, then it resets. It can drop when the Fed cuts, but it can also jump if inflation or other market forces, they push longer term rates higher. So here's the bond market translation. Fixed means lock a yield in right now and ride it. ARM means let your rate reset with policy moves. So if cuts arrive and stick, ARM fans may save a little bit more. And if rates pop back up, that fixed rate, it can quietly win. So Collin, what do you think is better for the current economy and market? Is it a fixed or an adjustable rate?
In the current economy, I think I would favor an adjustable rate, especially if they're more tied to short-term interest rates. They'd likely see that rate fall a little bit. And as we've discussed, in a fixed rate, even if the Fed cuts rates, we're not sure how much fixed rate mortgage rates will fall in that situation. And you'd be locking in at the current rate right now. So adjustable from a high level would make more sense in a Fed rate cut environment.
Very good.
And just to knock off people who are quite literally waiting to get into this market as they hear murmurs of a potential rate cut, what would be your message to those potential new home buyers? Is it worth even waiting?
Well, that would depend on each home buyer.
Yeah.
I don't know.
We're not giving specific advice,
no advice here.
but answer the question.
So what I would temper expectations. And going back to our Treasury outlook, because mortgage rates, they tend to follow the direction of the 10-year Treasury yield. And if we get the Fed rate cuts that we expect, and let's say they cut rates 2 times this year and maybe a total of a full percentage point over the next 12 months, which is kind of our baseline right now, we're not sure we'd see the 10-year Treasury yield fall by that same 100 basis points or full percentage point that the Fed funds rate might fall by. They might still fall, but not as much. So I think temper expectations, regardless of what happens with a new Fed chair, how the economy evolves. We don't expect the Fed to get back to that near zero level that we saw for a while. I think that's a good thing. It's good for savers who earn income from various investments. But if you're a potential home buyer and you're hoping you're going to see that 3 or 4% mortgage rate, I don't think we're going to see it that low.
Yeah.
Great explanation here. And just to briefly recap, I mean, we started with the entire yield curve. And I think one of the points that I would underscore is that interest rates affect different vehicles for investment across the yield curve. So at the very short end, you got savings rate, you got money market rates, then you go to get a little bit longer, you got CDs, then auto loans are affected after 5-10 years. Then you have mortgage rates as well. And I think one of the key things, we're talking a lot about the Fed here, is there is a tremendous demand for housing and people who want to get those low mortgage rates. It's an open question of whether or not those are going to come anytime soon. But as our guest here said, there is priced into the market 4 additional rate cuts going into the end of Fed Chair Powell's term, which ends next May. So having said that, I think we have wound things down here at Stocks in Translation. Make sure you check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app.